Okay, hello and welcome to the Foundations of Business, Financial Accounting, Financial Statements for a Business presentation lecture. In this presentation lecture, we will be going over the financial statements, which is a way that businesses are able to report their financial status to investors as well as upper management. What we talked about previously was in regards to the transactions of when money changes hands. Now it's taking all of that data, summarizing it, and formalizing it into financial statements. So let's take a look and see how this works. Let's get started. So in this section, by the time that we are done, hopefully you'll understand how to operate a business profitably and understand that in order to do so, must have a up-to-date financial information. And in order to do that, we will discuss some of the different financial statements that are used to do so. We will also talk about a statement of cash flows, which is cash coming in as well as cash going out. Computerized accounting system, which is used by most businesses in order to track and update their financial records. And there's many of these that are used synonymously with each other. So you really can't have financial statements without a statement of cash flows, and you really can't have financial statements that aren't being tracked in some type of a computerized system. So hopefully by the end of this section, you'll understand how to identify items included on an income statement, which is the analyzing of revenues and expenses, how to explain the purpose of a balance sheet, which is the proving of the accounting equation of assets equaling liabilities plus owner's equity, and then how to recognize the importance of a statement of cash flows, which is our one asset known as cash in bank, and how that has changed over the course of an accounting period. All right, why is this important? It's important to understand that current financial statements that analyze financial positions in order to make sound financial decisions about a business. So if we do not have the financial funds in order to do a particular business endeavor, we shouldn't be doing it. And this data in regards to our financial status is crucial in making some of those decisions. All right, so when it comes to financial statements, they are reports that summarize the changes that result from business transactions during an accounting period. There are a number of them that are used in a number of different businesses. We're going to talk about just a few of them here in our unit. So preparing and analyzing these statements is going to help us understand whether the business is on course, experiencing difficulty, or headed for serious trouble, which again will drive a decision making as to how to proceed after seeing the financial status. Preparing financial statements is another step in the accounting cycle. All right, so when it comes to the income statement, which is a report of the income or net loss for an accounting period, specifically the revenues or money coming in, as well as the expenses and money going out. The income statement for a merchandising business is going to have 5 different sections. So there's going to be the revenue section, which is all of the income. There's the cost of merchandise sold, which is the cost to us in order to provide our merchandise to be sold to the customer. There's the gross profit on sales, which is the amount of which is revenue minus cost of goods sold. And then there's also the operating expenses, which is to run our business enterprise in order to make these products, in order to get them to our customer for sale. And then finally, the net income, or in some cases, if our revenues were not high enough, a net loss. All right, let's take a look at a sample of an income statement. I think I've got this one here. Yep, much better to look at. So as you can see right here is the revenues. So from all the sales, here's the amount of sales that was brought in. Then when it comes to the cost of merchandise sold, this is an analyzing of merchandise in our inventory. So we had this much inventory on hand. We purchased this additional inventory, which gave us this. And then the inventory that we had at the end of the accounting period is this. So that indicates that we have a $196,276 cost of merchandise, which leaves us with a gross profit of revenue minus cost of merchandise at $96,343, which we also then have to subtract our total operating expenses, which are all listed here, leaving us with a net income of $38,247. So for this particular accounting period, looks pretty good. We definitely have a net income. Whether or not we have a desired net income is based off of business philosophy as well as goals, and then adjustments will be made accordingly. So if we analyze the income statement, it's a comparison. We can also compare income statements from previous accounting cycles to give us a trend of how the business is doing. So this is called horizontal analysis. So if we take a look at this, the Happy House Card Shop, we can see that based off of the previous year, the current year, the dollar change, and the percent change, we have different changes here, and we can see our sales are up 3%. That is good. Cost of merchandise sold, though, is also up 5%, so that could be a little bit concerning considering the cost of merchandise sold has gone up more than the sales. Our gross profit on sales is down a little over 1.25%, or around 1.25%, and our total operating expenses, however, is down almost 5%, so that's very, very good to see, meaning our net income has increased to almost 5.5%. So taking a look at all of these figures and comparing them will give us a very accurate picture as how we are doing at a particular point in time. Now you'll see percentages of sales. We will see comparisons in terms of financial analysis to be able to determine how we are doing, not necessarily on all of the numbers, but by taking certain numbers and doing statistical calculations to find out how we are doing. One of them is the percentage of sales. This is a very common analysis that is done to show the figures in the income statement. So for this one, you'll see we have the sales, cost of merchandise sold, and gross profit on sales. We have the amount in dollars and the percentage, and we can see that our gross profit is 34% of our total revenue. Our cost of merchandise is 65.63%. Then we also have the amount in dollars from the current year, and a comparison there. We can see our gross profit is down, and our cost of merchandise is up from the previous year. Now the balance sheet is a report that balances on all of our assets, liabilities, and owner's equity. This is the balancing of the accounting equation. It reports the business owns, owes, and its net worth on a particular specific date or point in time. The balance sheet represents the basic accounting equation. So a balance sheet would look like this. So as you can see, the balance sheet is broken up. Here's all of our assets, here's all of our liabilities, here's our owner's equity. So we want to make sure that the balance sheet checks out. So our total assets must equal our total liabilities and owner's equity. So we break it down by first listing all of our all of our assets, including cash and bank, listed here, total there. The liabilities that we have, what do we owe? Listed here, totaled here. And then the owner equity, listed here, owner equity plus liabilities equals our total assets. Our balance sheet checks out. Now we also can do comparisons of balance sheets and relate them to the assets, the liabilities, and the owner's equity from year to year. You can see that we have a different percentages of changes here, which is looking actually pretty good from this balance sheet aspect. The only thing that we do have, as you can see, we have an increase in liabilities, even though we also have an increase in assets. And our capital is still growing, but it did not grow as much as it did the year before. So businesses will use these different financial statements as a way to gauge their financial health. Now the statement of cash flows is an analysis of specifically just our cash account. It indicates cash going in, cash coming in, and cash going out. So a statement of cash flows is going to be broken up into a couple different categories. Cash inflow, this is the cash coming in from revenues, and then there's cash outflow, that is the amount of cash that is being used to spend on different operating expenses, liabilities, etc. Here's an example of a statement of cash flows. So a statement of cash flows, we can see that here are all of our cash inflows right here. We have sales to customers and interest from savings, $294,542. And then we have all of our cash outflows, which is our cash payments, so to purchase merchandise, to pay our operating expenses, and pay interest on loans, as well as our taxes. So we have $291,913. So that means we have a net cash flow in the positive from operating activities of $26,29, which means that we are stretched pretty thin on our cash account. We have just about as much cash coming in as we do going out. Now, in order to keep track of all of this, businesses will use a computerized accounting system. Most businesses use accounting software to record and report their business's transactions, but they are also used to analyze financial statements in order to determine our health, our financial health. Source documents are key to keep track of different transactions as they take place, especially for tax reporting purposes. Computerized is faster because it can actually incorporate an automated implementation and execution of the accounting cycle, where the accountant does not have to do every single step piece by piece, because the computerizing software will do some of that for him or her. And once the posting is complete, then the computer can print off some of the financial statements that are necessary in order for us to analyze our financial health, Some of those may include the trial balance as well as financial statements such as the income statement, balance sheet, and statement of cash flows. And this concludes the presentation lecture on financial statements for accounting in a business. If you need to, please make sure that you revisit the slides in order to complete the guided notes that go along with this. And I will see you next time we meet in class.